very warm welcome to our Informed Consent webinar, with a big thank you to our Platinum partner Zurich for working with us on this and previous discussions. Before we get started, I would like to acknowledge the Gadigal of the Eora Nation, the traditional owners and custodians of this land, and pay my respects to the elders both past and present. Folks, informed consent has been one of the big issues of the year. This is the third of our three webinars. There's been fantastic interest right across the country, which kind of demonstrates a number of things. Keenness to understand informed consent, address some of the confusion, and obviously for everyone in practice to get ready for the changes which are coming in next week. Delighted to welcome back Di Feeling to this event, to Matt Ellis as well, and of course Alyssa Hextel from NIBA. I will more formally introduce them in just a moment. Folks, the run for today is going to be the following. There are a number of new participants on this webinar, so we're going to do a quick check-in on webinar 1 and webinar 2, which is basically what was the regulatory and policy context that allowed or brought informed consent to us. Then a discussion on, so what are the requirements to get us all on the same point, and then we're going to then jump into the panel discussion. Over the last two sessions, there's been a lot of discussion, a lot of debate, a lot of questions have come through, so really appreciate those. This particular webinar, we're not going to have a chat and a Q&A session. We'll do that within the forum, mostly because most of those issues have already come through to the fore over the last couple. However, if you do have questions and you do want to ask them, please write to us at info@niba.com.au. That's info@niba.com.au. So that's the run of play for today, really designed to help bring clarity to, and certainly the feedback over the last couple was, it would be great to get some legal views from around the table. And with that context, obviously, Matt, a big thank you to you for joining. But perhaps to kick us off and to start us off, I'm going to head to Alyssa and then to Di, just to bring us up to speed on webinar 1 and some of the political and policy context. Alyssa, over to you.
Thanks, Richard. Before we kick off, just a short disclaimer. This webinar that we're currently in is intended for informational and educational purposes only. It's not intended to constitute legal or professional advice and should not be relied upon as such. While NIBA makes every effort to ensure the accuracy of the information that we provide, no responsibility is accepted for any loss or damage arising from reliance on the material provided. And as always, we encourage our members to seek independent professional advice where appropriate. So I'm going to start by talking through the landscape in which the quality of advice review and, more importantly, the informed consent obligations arose. So these changes are part of a journey that really began in 2012, but they're also part of a broader philosophical discussion that goes to the heart of a broker's role as a fiduciary. And that discussion has been happening within the market much earlier than 2012. But we'll start at 2012 when the FOFA reforms introduced a ban on commissions and volume-based payments. And at the time, insurance brokers and general insurance commissions were exempt from these obligations. However, for much of the financial advice industry, this really was the last step for commissions. There were some grandfathering provisions that were introduced to slowly phase out some of these commission payments, and they were phased out in 2021. At the time, the Hayne Royal Commission, which for us was, well, for financial advice more broadly, was a watershed moment and really brought to the forefront some of these deeper philosophical arguments that had been within the marketplace for quite some time, recommended that a review into exemptions to the ban on conflicted remuneration, so that's the exemptions for general insurance, life insurance, and consumer credit insurance, be reviewed. The Royal Commission found no evidence of poor consumer outcomes or systemic misconduct by insurance brokers. However, Justice Haynes' comments at the time around life insurance really speak to the attitude that was held about commissions within the market, both as a result of some of the misconduct that was highlighted as part of the review and just more broadly. And so those comments were that any decision that commissions should continue to be paid in relation to, at the time, life insurance products should be based on clear evidence that the harm that would flow from abolishing commissions would outweigh the harm that already flows from allowing this form of conflicted remuneration to continue. Fast forward to 2022, and we see a slightly different approach and a slightly different attitude towards commissions, where the Quality of Advice reviewer, Michelle Levy, found that no harm. While she wasn't strictly opposed to banning commissions, she did ultimately recommend that commissions be retained for life insurance, general insurance, and consumer credit insurance products. However, she did add the important qualification that retail clients provide consent, informed consent, before the advisor is able to receive commission. In 2024, we received the first tranche of legislation to enact some of these reforms. Included in that was the informed consent provisions. As many of you may remember at the time, the legislation almost accidentally removed commissions completely. And so there was quite a bit of engagement around ensuring that commissions were able to continue to be paid under the legislation. And now we're in 2025, where that legislation is taking effect. As part of our policy and engagement strategy around the Quality of Advice review, we commissioned Deloitte Access Economics to prepare a report into the economic value of the insurance broking sector, highlighting the value that brokers provide to insurers, clients, the broader community, and the economy. This really what formed a lot of the arguments that we carried through into the Quality of Advice review. We also lifted the standards, professional standards and disclosure through the Insurance Brokers Code of Practice through the introduction of section 6.1, so disclosure of commissions to retail clients, and also prohibited brokers from receiving certain forms of conflicted arrangements, such as volume-based commissions. Through the Quality of Advice review, we prepared 3 separate submissions. If anyone's interested, they are available on the NIBA webpage. We also engaged with ASIC, who were previously tasked with conducting the review, the independent reviewer, Michelle Levy, and took part in a number of industry roundtables. And then noting Justice Haynes' remarks around balancing the demonstrating the harm that would be caused to consumers as a side effect of removing commissions, we did just that. And we engaged and also empowered our members to engage with local MPs and ministers and senators to discuss any potential impacts of the review and its recommendations on clients. So ultimately, the Quality of Advice review recommended that brokers who provide personal advice to retail clients should be required to obtain the client's informed consent prior to receiving commission. The review also recommended expanding the definition of personal advice to cover most advice provided by brokers. So originally, this obligation would have applied to a much broader range of personal advice. While we supported disclosure in line with the Code of Practice, we did caution at the time, both in industry roundtables and in subsequent discussions with both the independent reviewer, Michelle Levy, and with government, that the obligation could result in clients being left without cover. And Di, I'd actually just like to bring you into this part of the conversation. If you could maybe talk a little bit around where we left off that conversation with Michelle Levy and kind of some of the conversations that took place behind the scenes as part of the quality of advice review.
Yeah, sure, Alyssa. I think the roundtable that I attended was interesting, and there was a lot of discussion around informed consent, and a lot of discussion around those unintended consequences of informed consent. What happens if you can't get that informed consent? And as insurance brokers, any insurance brokers that are online will understand how inherently difficult it can be to get written confirmations from clients, written information from clients, and forms, documents signed that need to be signed. So that was one particular thing. And the focus was, well, what happens if we can't get that? And there was a lot of discussion around an education, really, of Michelle around what happens in a broker's world from day to day. Implied consent, payment, saying yes, renew if you've got disclosure and you've got transparent disclosure of commission. Our code has that you need to disclose the dollar figure for whether you're providing personal advice or general advice. So there's a lot of information that goes to clients, and there was quite a healthy, what I thought was a healthy discussion and a real understanding of the impediments that could occur unintended if informed consent went through as it was. But we are where we are. And I think, Alyssa, I just want to, because I think when we talk about the Hayne Royal Commission, the 6 points that Hayne brought out about the fundamental norms of conduct are really things that sometimes we get lost. And I did, as you were talking, just bring it up on another screen, because they are things that if we focus on these things, it's probably good to focus on them, bring them to the fore at the front of this conversation, where there's 6 fundamental things that all brokers, I think, would agree are fundamentally explain what we do. I mean, the first one, obey the law. The second one, do not mislead and do not deceive. Third one, act fairly. Fourth one, provide goods or services that are fit for purpose. The fifth one, deliver those goods or services with reasonable care and skill. And lastly, when acting for another, act in the best interests of that other. And I think that those 6 points, to me, have always encapsulated what an insurance broker is really all about for what we do for our clients. So I just wanted to bring that in at this part of the discussion and have that at the forefront, because I think they're all relevant for the discussion around informed consent and the way that we should be going about it.
And I think they're really good principles, both for informed consent, but obviously there are some other changes that will be coming through sometime in the near to mid future. And I think kind of having those norms of conduct as the guide rails is really useful when thinking about some of these changes and how to implement them within broking businesses. So thank you. So we're just going to do a quick recap. We do have quite a few of the audience that weren't able to join us for webinars number 1 and 2. If you haven't seen those webinars, they are currently available on the NIBA website on demand, and they are CPD accredited. So I would encourage anyone to go back and watch those. They do cover slightly different material to what's being covered today, but we'll also just run through a quick recap before we get into our discussion. So from the 9th of July, 2025, so 1 week from now, Australian financial services licence holders and their authorised representatives who provide or are likely to provide personal advice to retail clients must obtain the client's informed consent to receive a monetary benefit in connection with the issue or sale of a general insurance product prior to the product being issued or sold. We've put together this simple flowchart that doesn't take you all the way to whether or not you must provide informed consent. As we'll discuss a bit later, there are some grandfathering provisions and some provisions for renewals, but this is a very good place to start and a really good place to start the thinking as well. So the first step is, are you providing or likely to provide personal advice? If the answer is no, if you are providing general advice, please, when I'm saying are you providing personal advice? That does also mean, are you behaving in a way that a reasonable person would be likely to assume that they are being provided with personal advice as per the Westpac v High Court decision? So if the answer to this question is yes, we move on to the second step, which is the client an individual or a small business as defined by the Corporations Act? So the Corps Act defines a small business as one with less than 20 staff, unless they're involved in the manufacturing of goods, in which case it is 100 staff. Again, if the answer is no, the informed consent provisions do not apply. Third step, is the general insurance product one of the following? So motor vehicle insurance, travel insurance, home or home contents insurance, sickness and accident insurance, consumer credit insurance, personal and domestic property insurance, or medical indemnity insurance. Again, these are the general insurance products currently listed as part of the retail client test. The informed consent obligations do not alter the retail client test. So these are the steps that you would normally go through when determining if you are providing advice to a retail client. If the answer to this third step is no, the informed consent obligations do not apply. If the answer to all three of these is yes, then you can continue on and we can look at how you comply. So to comply with the informed consent obligations, insurance brokers must firstly obtain the client's informed consent to receive the monetary benefit before the insurance is issued or sold. Secondly, they must have the client's written consent or a copy or a written record of verbal consent that the client gave. And they must then provide the client with a copy of the written consent or a record of verbal consent as soon as practicable after the consent has been provided. Before brokers can obtain informed consent, there is information that must be disclosed to the client. This includes the name of the insurer, if known, the rate of monetary benefit the insurance broker will receive. This is expressed as a percentage of the policy rather than a dollar amount as required by the code. The frequency and period over which the broker will receive the monetary benefit, the nature of any services that will be provided to the client, a statement that it is a requirement of the law that the client's consent must be obtained before the payment of an insurance commission, and a statement that the client's consent, once provided, is irrevocable. ASIC does state in its guidance that brokers are able to rely on information that has been previously provided through other documentation. However, the client must have a genuine opportunity to provide informed consent, and so those two things must be balanced. So while you can rely on the provision of some of this information through an FSG, it does need to be balanced with the opportunity for the client to have made an informed decision and provided informed consent. As I mentioned earlier, there are some grandfathering provisions and some provisions for the treatment of policies in place prior to 9 July and also post 9 July. So the grandfathering provisions that apply for business in place prior to 9th of July. We are aware of a number of conflicting reviews about the operation and application of these provisions. And so for business in place prior to the 9th of July 2025, we do encourage our members to seek professional advice on this matter, or if they are part of an organisation that has already been provided with advice or guidance, to follow the advice or guidance that you've already been provided. For business in place post 9 July 2025, once informed consent has been obtained, brokers will not need to obtain a new consent at renewal, provided a number of conditions are met. So the first is that the information that was provided prior to the product being issued or sold, the client was informed that the consent would apply to renewals. The second is that the information disclosed to the client at the time of the original consent remains unchanged at the time of the renewal. And the third is that the rate or frequency of the monetary benefit is equal to or less than that disclosed when the original consent was obtained. So consent for a range between 5 and 30 is also taken to be consent for a commission of 20%, as long as it falls within that range that was previously disclosed. If the commission is higher, a broker will need to seek a new or amended consent from the client, and again, provide a copy of that, retain a copy of that amended consent on file, and provide a copy of that amended or new consent to the client. And that's covered in more detail in webinar 1. Richard, I'd just like to hand back over to you. I think we've got some questions and some really juicy topics for our panel discussion.
We do indeed, and thank you, Alyssa, and thanks for that recap. And yeah, to your point, to anyone who is online who missed 1 and 2, there's a much more fulsome discussion on all the topics that Alyssa has covered off. But look, folks, my pleasure now to more formally introduce Di and Matt. Firstly to Di. Di is a very well-known figure in the insurance sector with a career spanning over 45 years. She has an extensive background in insurance broking, and she has dedicated 37 years to mastering the intricacies of the field. She currently serves as the COO at BJS Insurance Group, and she has spent the last 21 years contributing her expertise and leadership to the organisation, as well as fulfilling many, many roles inside NIBA and the broader sector, including as her tenure as president of NIBA. To Matt, big welcome to Matt. He's a partner at Spark Helmore Lawyers in their commercial and corporate practice and leader of its regulatory and advisory team. Matt has over 20 years experience advising on transactional and regulatory work for the insurance sector, has worked both in the Australian and London markets. He's a board member of the Australian Insurance Law Association, a committee member and secretary of the Victorian Insurance and Reinsurance Discussion Group. He's noted in the Legal 500 in the financial services and fintech category and best lawyers in insurance, and was recently a nominee at Lawyers Weekly Partner of the Year for both insurance and financial services categories. So big welcome formally to both Matt and to Di. And Matt, I might throw to you first if I can. You know, one of the themes that's turned up significantly over the last few webinars and prior to that has been a lot of the confusion that's kind of sitting around the marketplace in brokers' minds about what should or shouldn't they do. Perhaps if I can throw to you and go, so what are the areas of confusion, and what's your broad guidance that you've been advising your clients?
Thanks, Richard, and thanks, NIBA, for having me on. Yeah, it's been an interesting journey, I suppose, over the last little while, and I've seen some of the feedback and comments made from past webinars. Obviously, a fair degree of frustration, I suppose, amongst the industry and understanding how these reforms apply. And really that frustration we're seeing with our clients as well is turning what was always meant to be a relatively simple reform and simple compliance procedure, trying to operationalize that and realizing the complexities that come with it. The reality is, and you know, anyone who's worked with lawyers will probably not appreciate or not fancy hearing it from a lawyer, but every time you look at reforms like this, the reality is that there are complexities. And no matter how simple the reform's proposed to be, no matter how limited the reform and the issue that's being addressed, different interpretations will arise based on the wording of the legislation. And we have, unfortunately, in Australia, one of the most complex regulatory regimes around financial services in the world, and that's because it has been built year after year on successive reforms, layers upon layers of reform, each of which don't really always align neatly with the reform and the regime before it, whether through the words that are used to define terms otherwise. The upshot of all of that is the unfortunate reality is whenever there's a reform like this that impacts the insurance sector, there are teething issues, different interpretations and complexities that arise from adopting. Having said that, I think we've seen some of or heard through our connections and our clients some of the areas that people are finding most difficult to manage in this space, and the different interpretations that are arising. My sort of overarching comment around that, and I'll come to some of the areas to explain a little bit more detail, but my overarching comment around that is that there are, we think, sort of pragmatic and practical solutions that can be adopted in a compliant way under this regime, that are sort of strict black letter interpretation of some of these provisions doesn't necessarily, it might be the most risk-free approach to compliance. And so if that is the best approach in the circumstances, if that's your risk tolerance, then absolutely I'd endorse the approach that's least risky in terms of compliance. But that doesn't mean that there are not other approaches that we think are acceptable. It really does come down to your views, your legal advisor's views on the provisions, and your sort of risk tolerance to particular issues that arise in that context. Maybe picking up a couple of the areas that we've seen people going back and forth or agonizing about in a little bit more detail. And thanks, Alyssa, you've sort of hinted at a couple of them already in your introductory comments. But for example, the grandfathering provision. So there's a lot of focus in these reforms around relief on renewals. And there's a very clear rationale and reason for that. And it goes back to Di and Alyssa's conversation about what got us to this point. Michelle Levy, in her report, and based on all of the hard work that NIBA and Di and others have done in this space in advocating the broking sector's position, recognise very clearly that not all circumstances was the ability to obtain informed consent available to brokers, and particularly on renewals of policies, because it was recognised very clearly that while brokers have an initial conversation and they provide personal advice, if they're providing personal advice in this context for products that this regime applies to, on the first initial sale of that product, they'll have a conversation, and it's much easier to obtain consent in that process when the conversation is happening than on every subsequent renewal of that product post adopting or purchasing the product, at which time conversations tend to be very limited or non-existent. Policies are rolled over and renewed either automatically or through very limited correspondence, and so obtaining consent in that forum is very difficult. And Michelle Levy clearly accepted that, and her recommendations and what now appears in the legislation very much recognises that issue. And it comes through in two ways. There's two particular relief provisions that exist under this regime. One deals with policies that were entered into prior to these reforms taking effect, so policies that were first issued before 9 July 2025, which is obviously very fast approaching this time next week, which the effect of which is intended, at least in my view, to provide that so long as the policy is acquired or purchased prior to the reforms taking effect, then any subsequent renewal of that product post the reforms taking effect is outside of this regime, i.e. you do not need to apply the informed consent or obtained informed consent on a renewal of a policy that was issued before 9 July 2025. There is, as Alyssa alluded to, some debate around that, and I'm aware of some broking groups who have issued some guidance that suggests that only the first renewal of the policy is subject to the relief, i.e. your first renewal post 9 July, you don't need informed consent, but every subsequent renewal after that you will. I have to say I don't share that view, but we're not giving legal advice on this call. I'm very happy to have a conversation with anyone who's interested more in that position. But I think the intention of this relief was to provide what we describe as grandfathering relief. That is to say that policies first issued prior to these amendments are outside the scope of this, including all subsequent renewals of the policy. So that's where that issue comes through, and that's where the sort of tension or the differing views in the market land on that point. The second and related one is around the relief for renewals post the implementation or post 9 July. So if you have a policy that is first issued after these amendments come in, then that policy is clearly caught by these requirements. And then the question is, what does renewal mean in that context? So there's relief effectively, as I think Alyssa or Di, you described, once you have a policy that's entered into, provided you have told the customer or your customer that the that the consent they're giving applies also to renewals. So you have to have a very particular language that you use to make sure you get the consent in the right way. Provided you have that consent and that the commission rate does not go up, it can go down, but it does not go up, then you are within what is the relief for the renewal relief for the post 9 July regime. And that just says if those two things apply, as in the commission rate only goes down, doesn't go up, or it stays the same, and you've given the right consent, then you don't need further informed consent from them for the renewal. So it's effectively giving you relief. Again, based exactly on the premise that Michelle Levy adopted, that was advocated for by NIBA and others, that on a renewal, it's very difficult to obtain another informed consent, and it recognises that difficulty, focusing very much on the commission rate itself. If the commission rate goes up, then clearly you need informed consent. The difference or the tension amongst different views in this space is how that interrelates with the variation provisions. I'll say two things. What renewal means, as in, does renewal mean renewal with the same insurer, or does it mean renewal of the same product type? Because, for example, some people might have the view that you do not need to obtain a second informed consent if you change the insurer, because it's just a renewal of the same product, and therefore the renewal relief applies. That sort of leads into the second difficulty around that, which is the variation provisions under this. It says that if you vary the consent, or if you vary certain of the information that's been disclosed during it, you can obtain a varied consent, and that will apply. And one of the express provisions of that says that if the insurer changes, then you would get a varied consent, or you could get a varied consent. So in my mind, there's a bit of a tension between those two things in the legislation. One sort of suggesting if the insurer changes, you need a new varied consent, but the relief itself, on which you would rely for renewals, does not contain that requirement. So different views on that. You know, I have a view on which I'd prefer, but I think, again, it at the very least leaves open for the industry to consider pragmatic solutions to these issues, and to consider how have a discussion with your legal advisors and otherwise your compliance people internally about how you define renewal in that context, what's appropriate in terms of this legislation. In that context, there's also some other arguments about midterm adjustments, other things. Does that constitute a variation that requires a new consent? Sort of complex arguments around that. All I'd say is that this legislation applies to the issue or sale of products. Midterm adjustment, you'd have to look carefully whether that is actually an issue or sale of a product. A midterm adjustment might not fall within this regime at all, depending on what's actually happening. And sorry to ramble on, the last point I'll just make about areas where there's a little bit of contention is this distinction between express consent and informed consent. Some guidance I've seen or some advice I've seen over the last little while suggests that the only consent that will satisfy these requirements is an express consent. And what I mean by that is, a clear written or verbal consent given by the customer in response to a direct question about consent being given. Clearly, that is the ideal, and that's what the legislation, if you can do that, that's what you should do, without doubt. Express consent, the legislation requires you to either obtain consent in writing or have some other record of consent. Now, I would argue that that other record of consent can provide an avenue to obtain what I would describe as implied consent, depending on the circumstances. And the case law around what constitutes implied consent, what constitutes informed consent under analogous regimes does provide for implied consent to be given. And when I say implied consent, I mean consent by conduct. So, for example, the classic one is paying an invoice, for example, might be a piece of conduct by a person which demonstrates their consent. Now, I raise that as an example just to demonstrate what consent by conduct can mean. But in this context, actually, that's very difficult to rely on the payment of an invoice as implied consent because of the timing. You have to obtain this consent before the product is issued. And almost always the payment of any invoice will follow that, which means that will not be an avenue that you could rely on. But it doesn't mean that there might not be other circumstances, other arrangements, other positive steps taken by a customer in circumstances where it's difficult to get their actual written consent, on which you might form a reasonable view that you have obtained their informed consent, albeit it's implied. Again, sort of complex areas, but pragmatic sort of outcomes based approach to this legislation, I think, is open, and where there's sort of difficulties in your own internal processes and structures in obtaining the consent in a really clear and robust way, which, as again I'll say, is the ideal and most appropriate way if you can do it. There are other options I think are available.
Matt, look, thank you for that. I might just dive in with a question and then flick it to Di as well. I mean, I guess what I'm hearing is what seems simple is actually not when it's applied. That brokers need to get good legal advice, but there's a business decision here as well, right? Around what kind of business model do you have, what kind of engagement do you want to have with your clients, and ultimately what's your risk appetite in terms of how you govern your business. I wondered if you could just make a couple of comments on that, and then perhaps Di, I'll throw to you just for how did your organisation think about those questions and then ultimately implementing the informed consent changes. To you, Matt.
Sorry, Richard. I thought you were throwing a question to Di. Can you just repeat the end of that question?
Yeah. So perhaps if you can just comment on that kind of conversation around, yes, it is complex, but in the end, a business needs to make a call, mindful of their business model, mindful of their risk appetite, mindful of what works for their clients.
Yeah, absolutely. I mean, that really is the circumstance. As I was sort of trying to set the scene a little bit early with any regulatory reform, I mean, this same issue applies whether we're talking about the distinction between personal advice and general advice, whether we're talking about bundled products and how they fit within the regime. This regime is a really complex one. And so any reform needs to align, well, any reform like this, you need to work closely in forming a view on how it operates and your own industry view, supported preferably by legal advice, internal or external, where you think that there's need for that, where it is sufficiently complex and the consequences of getting it wrong justify that. But also align it practically to the solutions that you have. So in this regime, as I've said, the real difficulty that we've seen with clients that most are grappling with is around specifically this renewal piece and how do we make sure we comply? How do we get the right information in front of the clients and distill from the way that we interact with our client the relevant consent, where it's really difficult to do that in a very express and obvious way. And so everyone has different business models. We have digital distribution channels, we have telephone, we have online, we have all sorts of different methods to deal and liaise with clients. Other brokers with really long-standing existing clients, some with shorter relationships and more difficult to manage. So all of that needs to be factored into the structure that you adopt. But as I said, the sort of overriding comment I'd make is that this regime is really not intended to create an onerous compliance burden. And the explanatory memo that sits alongside this legislation and other material around it really makes that clear. So I think that gives a certain degree of flexibility in the approach that you might take.
Which is an important point that obviously sits with ASIC and those documents being made pretty widely available.
Yeah, it's a good point on ASIC. Actually, I should have mentioned in one of the points that we were talking about before about this sort of conflict between the renewal relief for post 9 July renewals and the variation mechanism. It's clear from the guidance that ASIC has a particular view about that might not be a view that's shared by others. So again, these things make these areas a little bit fraught in terms of how you position yourself in compliance. But I think you should obviously, following what the regulator says is the most risk-free approach, and probably what most lawyers would recommend you do if you can do. But obviously, the regulator's interpretation of provisions is just that. It is their view of the way the provisions operate. Doesn't necessarily mean that the court would adopt the same approach.
Thanks, Matt. And then, yeah, Di, over to you so how did BJS think about these issues and what have you folks done?
Yeah, so thanks, Richard. I think it made it simpler for us. We've always worked on a personal advice model. So when you go back to the slide that Alyssa showed earlier about, are you providing personal advice? What is a retail client? Yes, yes, yes. This is just another layer of compliance and complexity that's been added to those things. But really new business, I think, as Matt's alluding to, we talk to our clients, we do act on a personal advice model. And so for us to have a conversation around that, to get their consent, confirm it in writing, or get them to sign a form is not the difficult part. That's a fairly easy thing to do. There's certainly complexity around the renewals, and it took a fair bit of conversation for us to come to where we landed on what we're going to do with renewals. But also too, there is the practical implementation. So how do you easily work this into workflow? Not just from a practical operational sense, but recording of it and being able to report on it regularly as a compliance tool. We all have compliance reporting in our business that we have to that we use to make sure and monitor that we are meeting those compliance standards. And so how does that come from a practical sense? And obviously IT is very important there in the systems, and we use systems that we use for workflow steps, and they're certainly being built into that, and a guide. But I think we take that that approach that we've always tried to do the right thing. Those 6 Hayne principles are very clear in our mind. We always try and put the client's best interests first, and we would always try and comply as strictly as we can to be that sort of broker. That's our value proposition. So it is difficult. The renewals is definitely, without a doubt, the most difficult part of all of this for, I think, every broker. We wouldn't be alone in that. I think from any broker that I've spoken to, the renewal part of it is the most difficult part. But again, it's educating the client, isn't it? And we constantly try and educate our clients. I think when I was president, a lot of brokers who may or may not be online today would have heard me talk about the importance of transparency, of educating clients, and the fact that as insurance broking, as a profession over a long period of time, I think we added huge amounts of value to our clients. We are just fairly humble about it, and we do not educate our clients about all of the wonderful things that we're able to achieve. And I think anything that introduces an education component from our client, and this is all about how we drive our income, how we actually, this is our income, this is our value, and then let the client decide whether those align, is a step in the right direction. I think that over a long period of time, we've been talking about, and back I said in 2025, I thought insurance broking would look a lot different than it did back then when I was president. I didn't know what it was going to look like. It probably doesn't look as different as I thought it might be back then, but certainly I think we're on the cusp of that, and this is just the first wave. And if you have an approach of just, it is what it is, and we have to build it in and use it as a tool, a bit like our terms of engagement. I think I said in the last webinar, the code of practice, introducing the terms of engagement was very much another education piece of clients. Understand the service you are going to get from us, and every broker's service value proposition will potentially be different. And that is the value that we bring in the services that we provide, and use that not as another compliance document, but as a document of education and discussion with clients around what you do, how we get paid for it, and ultimately the client should understand and be able to make a decision about the value and the income that we derive. So it's not easy. We're still going through that implementation process. I've had some training sessions, still a lot to go. But for us, the new business piece is not really the difficult part, because as Matt said, we're talking to our clients at that point when we enter into the contract. And so it is an interesting concept of, you change insurer, is it a new contract, is it a renewal? I mean, we're taking it, it's a new contract because we just think it's another, we're doing that, and that's what we're doing. Also, too, I think one of the things that has been in the back of our mind, the more complex you make it, the more difficult it is for your people to actually adopt the change. If you try and streamline, and that's what we've tried to do, is say, where can one set of rules and workflow be adapted without all of these variations? We're probably going to be in safer compliance ground if we do that. So it might be, I mean, can you over comply? I'm not sure whether you can over comply. You can certainly under comply, and that's something we definitely have never wanted to do. But I think building in a set of steps that make sense to our people, again, if they're long-standing clients, they're going to understand it. They're going to know the commission, because as insurance brokers, we've been providing that figure to them since the last code came in, whether you're providing personal or general advice. And to get that consent is just a good conversation to have with clients.
Awesome. Thanks, Di. A lot of richness in that answer, both around how you manage change, but also kind of keeping first principles first, and then kind of making it implementable and as simple as possible. Di, you also raised a question, which I'm going to now throw at Matt, which is, there's been a lot of debate around general versus personal advice, and some views that maybe there's an ability to change that up. And Matt, I was going to ask you, so what are the risks of doing that that are in the marketplace right now, and what are you seeing in this regard?
Yeah, thanks, Richard. I mean, I suppose the debate or the complexity around general versus personal advice has been an issue for a long time. Businesses have grappled with that in all sorts of different ways and have their own distribution models in place already, whether they adopt a personal advice like Di's business or others rely on general advice models. It's sort of a known complexity. What I'd say about that in this context is what we've seen or what I've heard anecdotally in the market is there has been a little bit of a drive maybe to try to minimize the complexity around this requirement by moving business or trying to change the approach to business a little bit. So move it, as you're sort of suggesting, move from a personal advice to a general advice model, or to recategorize products, for example, to be wholesale, particularly bundled products, other things, sort of re-examining the way that businesses have landed on the view that they're providing personal advice and that they're retail clients, i.e. trying to recalibrate those things. I guess all I'd say to that is that if you're providing personal advice, you're providing personal advice. And if you're dealing with retail products or retail clients, then you are dealing with retail clients. So if you do change your distribution model such that you are no longer providing personal advice, actually, then this regime will not apply to you. But if really what is happening is sort of revisiting, not really changing anything, but just revisiting how you've reached the views on how it's done, effectively sort of reimagining how business is done without actually changing it, then I guess I just urge caution around that to make sure that you're getting the proper advice, that it is either no longer, for whatever reason, a retail product, or it is actually general advice and not personal advice. Because as Alyssa very capably demonstrated with her diagram, once you hit yes to those three questions, this regime will apply.
And to Di's point earlier, I mean, we're talking here about the future of the profession and what our promise to clients is or are, and doing the right thing right now kind of becomes fairly critical. That's right, Di, isn't it?
Yeah, I think so. I mean, my view's always been that a client who comes to a broker wanting a broker to look after their insurances or their risk management program is wanting advice. I mean, inherently they would be assuming they're going to get that advice. I've seen general advice models and heard a bit about genuine general advice models, and it can work. For us, it's far easier just to go, I say to our people, if in doubt, it's personal advice. It's just easier to do it that way. The client can probably expect that in a lot of instances. They'll be expecting to get the advice. They'll be expecting you to consider what their needs and objectives are, and give them advice and recommendations on what the right insurance product is for them. So sometimes, you know, we look for ways to avoid something when really, practically, when you get through the practicalities of implementation, it just becomes a well-oiled machine and something that you just everybody builds into their day-to-day processes, because it just becomes a habit of education, which is a good thing for clients. Far better consumer outcome.
Awesome. Thanks, Di. Folks, we're at 3:51. I've got one last question before we wrap. I'll go to Matt first and then to Alyssa. Matt, we've just had the recent federal election. Dr. Dan Molino is our new appointed minister, assistant treasurer. There was obviously a lot of stuff that was in train through Minister Jones's tenure. What's your read of what's coming down the pipe, and what do you think the priorities will be for the incoming government, and in particular Minister Molino?
It's a good question. Always a bit difficult to predict how the politicians will swing with various issues, but clearly the delivering better financial outcomes reforms are continuing. So that's this whole quality of advice review has led into those reforms. They're being delivered in tranches. We're up to, I think, tranche 1's been delivered. Tranche 2A has gone into consultation recently. Tranche 2B is yet to go to consultation, and that is probably the more interesting and complex changes to the best interest duty and qualified advisors, which is, we haven't had a lot of guidance yet on what that's going to look like from the actual legislation. All of that, it looks like the minister is very, very keen to push. All the messaging so far is that's going to be the priority, getting the financial advice reforms through. Having said that, I think for the first time in many years, and you, Alyssa and Di might have a view on this as well, but I think for the first time in many years, the pendulum might be swinging back a little bit away from a view that we need more and more regulation. So we've come through a very, very intense wave of regulatory reform since the Royal Commission, which has been, hugely important in lots of respects to deal with some identified issues, but also very onerous on business, very cost intensive, and that, whether you're broking sector or broader insurance sector has really occupied a lot of time and cost. And I think for the first time in a long time, we're starting to see a little bit of pushback or accepted pushback from government on cutting regulatory requirements a little bit, being a little bit more open to accepting a more industry government cooperative approach to certain issues, which might see us maybe slowing some of the more onerous regulatory reforms down a little bit over the next few years. But I say that that's just a possibility in the context that we've been in. I think for the moment, definitely the finalising these delivering better financial outcome reforms will be number one priority over the next 6 months. And the word on the street is we'll get that tranche 2B package through in the second half of this year.
Fantastic. Thanks, Matt. Alyssa, you're pretty close to the flame on all of these reg change issues around the federal government and state governments. What's your sense of answer to that question?
As Matt mentioned, 2B is really where things get interesting. That's the modernised best interest duty and the new class of financial advisor, whatever they end up being called. And they're reforms that we will be watching very closely and very involved in that process once that process kicks off. More broadly, Minister Molino has a very strong background in economics, like his predecessor. And so I think his focus is going to be on some of the key economic principles. So possibly things around encouraging market participation, opportunity cost, the role of government. I think that's where he'll turn his mind to. He was obviously instrumental in the response to the government's inquiry to insurers' handling of flood claims, and there is still many items to come from that. But I think with his background and the broader portfolio that he now is responsible for, I think we'll really start seeing some of these macroeconomic principles come to the forefront. And possibly some very different discussions than we're used to in terms of how we can make advice more affordable, more accessible, and improve the general insurance market more broadly.
Awesome. Thanks, Alyssa. Folks, I'm going to wrap by saying three things. Number one, just a big thank you to Di, to Matt, to Alyssa for joining us, obviously for this webinar, but also for previous ones. This has been recorded, will be up on screen sometime soon. So yeah, all of the virtual hand claps, thank you, folks. That's really appreciated. Look, three other quick things to share with you. We'll obviously stay in the conversation on informed consent, so watch out for that. NIBA's just about to go on road for the gala lunches, so we're really hoping to see you somewhere around the countryside. Over 2,500 people have now registered. Today, picking up Di's theme around the future of the profession, we've launched our research questionnaire. So appointed an external group, so look out for that. We're really keen on people's views on everything from the future of the profession, pathways into the profession, education, outlook, and so on. And of course, last one is that NIBA convention, 19 to 21 October, is well in build mode. We're in really good shape for that, and we're looking forward again to engaging with everyone there. So folks, at 3:57, have an awesome afternoon. If you're anywhere in the weather bomb, stay dry, stay warm, stay safe. And to everyone, have an awesome start to the financial year. And we're a week away from kicking off informed consent, and that's been the topic du jour. So I hope this has been an informative discussion, and bye for now, and have a good rest of the week. Cheers.